Welcome to PIMCO Pod. In this episode, we discuss the high-level outlook for U.S. policy in 2025, along with macroeconomic implications. Stay tuned after the conclusion of the podcast for additional important information. The 5 Ds of Trump's second administration. Key Economic Themes by Libby Cantrell and Allison Boxer. On Monday, President Donald Trump began his administration with a flurry of actions on immigration, regulation, trade, and more. While uncertainty remains high, we see several overarching economic-related themes for investors coming from Washington this year. The new administration's policies could be a mixed bag for the economy. Some will be positive for animal spirits and growth, while others could hinder growth and market sentiment, or limit progress on inflation. The cumulative impact for both 2025 and 2026 will largely depend on the scope and sequencing of the policies, and how markets and other countries respond. In our baseline U.S. outlook, where tax cuts are extended, tariffs are increased, and spending cuts are modest, we expect the fiscal growth impulse, that is, the impact on growth from policy changes, to be modestly negative to flat this year, while inflation is modestly higher, and the Federal Reserve can remain focused on gradually normalizing policy over time. Read more about the U.S. and global economies in our latest cyclical outlook, Uncertainty is Certain. The key themes, we call them the 5 Ds of the second Trump administration, in no particular order, are deglobalization, deficit finance tax cuts, DOGE, deportation, and deregulation. 1. Deglobalization. Similar to Trump 1.0, we expect Trump 2.0 to focus on an America First policy, particularly as it relates to trade. This will likely include tariffs, export controls, and more scrutiny, if not outright prohibitions on capital investment, all of which Trump 2.0 can more or less do without Congress. We expect some announcements during Trump's early days in office to underscore his seriousness about tariffs. On day one, he directed his cabinet secretaries to investigate and recommend appropriate measures to address the trade deficit in goods. While this was far from the kinds of severe actions, that is, a universal 10% tariff that many observers thought could happen on day one, we would caution investors not to read too much into it. Trump believes tariffs work on their own or as negotiating tactics, and we expect to hear much more from Trump on trade policy. Specific to Mexico and Canada, areas of immediate concern to many investors, sector-based tariffs may be more likely than broad-based, though it is ultimately Trump's decision. What are the likely macro effects? While many investors have focused on the potential for tariffs to raise prices, both for finished goods imported and sold to consumers directly, as well as for intermediate goods used by U.S. producers, we believe tariffs would also likely have negative growth effects, at least in the short run. In our baseline outlook, we expect modestly higher core inflation of around 20 to 40 basis points in the U.S. in 2025. The negative growth effects would likely be of a similar size. However, the impact will vary significantly depending on several factors. How broad-based the tariffs ultimately are. The more widespread, the higher the chance of broad-based economic retaliation from other countries, along with reduced potential for import substitution by U.S. consumers and manufacturers. The extent of any exclusions. The China tariffs under Trump 1.0 ultimately had many exclusions for certain products, as well as sequencing of tariffs. The timing of the tariffs is crucial, specifically whether tariffs are front-loaded or feathered in over time in conjunction with effects from a tax bill and deregulation. The responses of other countries, including retaliatory tariffs and changes to currency policy, are critical. For instance, some of the possible adverse effects of the Trump 1.0 tariffs may have been offset by a stronger U.S. dollar and a weaker yuan. For details, please read the 8th January 2025 macro signposts. One clear winner from tariffs? The U.S. deficit. It could decline as customs revenue, currently around $100 billion per year, stands to rise significantly, depending on the ultimate composition of tariffs. 2. Deficit finance tax cuts. A significant focus on Capitol Hill this year will be addressing the expiring 2017 Tax Cuts and Jobs Act. If there is no action on this, then around $4.2 trillion in tax cuts over 10 years, largely on the individual side, would expire at the end of 2025. Trump has also discussed passing additional tax cuts, such as no taxes on tips, a state and local tax, SALT cap increase from the current $10,000 limit, and a corporate tax cut for Made in America companies. What are the likely macro effects? The biggest impact of tax cuts is likely to be on the deficit. There are a lot of outstanding questions about how the tax bill will be structured. Will tax cuts only be extended for 4 or 5 years to reduce the cost of the bill and be paired with pay-fors that increase revenue over 10 years? Or will some of the louder voices who believe that tax cuts do not need to be paid for prevail? Regardless of the ultimate details, we believe tax cuts will likely add to the deficit over the long run. However, while the price tag of many of these proposals is large, we expect there to be a positive but limited impact on growth in 2026. Most of the focus is on extending tax cuts that are set to expire at the end of 2025, and keeping tax rates unchanged would have no effect on growth. Some of the other tax policy changes on the table could provide modest tailwinds, as will reduce tax policy uncertainty. But we do not expect further tax cuts to significantly change the macro outlook. Bigger picture. While the long-term outlook for U.S. government debt is likely to remain a significant concern, some near-term deficit improvement seems possible given potential tax policy, spending cuts, and higher tariffs that boost government revenue. 3. DOGE, the Department of Government Efficiency. DOGE seeks to use technology to address inefficiencies across the U.S. government. Although the Day 1 executive order to establish DOGE made no mention of spending, DOGE's original purpose included recommending spending cuts as well as boosting efficiency. Keep in mind that except for some small discretion around when outlays are allocated, the potential use of an esoteric tool called impoundment and potentially imposing restrictions on how states spend healthcare funds, the executive branch has little ability to cut spending itself. Any significant spending cuts will have to go through Congress. Our view is that, with or without help from DOGE, we are very likely to see some spending cuts passed as part of a broad reconciliation bill, in addition to the rollback of some elements of the Inflation Reduction Act, IRA. The increase in net revenues could range from $100 billion to $200+ billion per year. Much more than that would be asking a lot given the skinny House Republican majority. What are the likely macro effects? We think at least some of this reduced spending would be spent passing new tax cuts. So it is unlikely to directly reduce the deficit, although it could help reduce the increase in the deficit. At the same time, Trump said nothing about deficits or debt in his inaugural address, and spending cuts may be harder to pass in a small House majority than some observers expect. 4. Deportation. We expect immigration to be center stage under Trump 2.0. Indeed, one of the Day 1 executive orders was again declaring a national emergency at the southern border. We think many of the initial actions, such as restricting asylum applications, will be focused on stopping the flow of migrants. However, President Biden's actions at the southern border in June 2024 have already significantly slowed the number of migrant crossings relative to the 2023 peak. While we could see Trump try to close the border completely, he is also likely to focus on deportation. But there he will likely need Congress to provide funding for more broad-based actions. What are the likely macro effects? Most economists believe that growth would see a more immediate negative effect from the restriction of immigration, since immigrants start consuming food, shelter, etc. immediately when they come into the country. Much of the growth headwind is likely baked into the 2025 outlook already, given how Biden's policies have decreased immigration. So the bigger impact could be in 2026, should we see a broader deportation program. The inflation impacts would tend to be more mixed. Reduced labor supply could put upward pressure on wages, and we expect decreased immigration to help lower the unemployment rate this year, all else equal. However, we also think that slower immigration could reduce inflation in areas such as shelter, resulting in inflationary effects that are more ambiguous overall. 5. Deregulation. Similar to 2017, we saw a slew of executive orders on Day 1 of Trump 2.0 aimed at reducing regulation. Many of these orders seek to undo what Biden has done, similar to how Biden undid what Trump did. We expect the second Trump administration will also seek to roll back existing regulations. This would likely be more evolutionary than revolutionary, but it probably would involve a much lighter touch on enforcement. We think an obvious focus will be on financial regulation, including the Consumer Financial Protection Bureau, CFPB, and the Fed, as well as energy and climate-related restrictions. Indeed, in his inaugural address, Trump declared a national energy emergency and declared, "Drill, baby, drill." What are the likely macro effects? We may see a modest growth tailwind from reduced policy uncertainty, as well as improved animal spirits and sentiment. Survey-based economic indicators show early signs of greater policy certainty supporting U.S. hiring. Bottom line for markets, the economy, and the Fed. There are more questions than answers as to how the 5Ds will ultimately affect the broader economy. Much will depend on their scope and timing, as well as responses by other countries and the markets. Overall, we may see some broadly positive policies for growth and risk markets, and others that could give the markets indigestion. Our baseline anticipates policies that are flat to modestly negative for growth in the short run, while pressuring inflation modestly higher. Given the views on growth and inflation in this baseline would apply opposing pressure on the Fed's dual mandate to support maximum employment growth and stable prices, how will monetary policymakers react? Even with higher tariffs, we think the risk is tilted toward more rate cuts in 2025 than markets currently have priced in, not less, for several reasons. First, Fed analysis, released in 2018 on the impact of tariffs in Trump 1.0, was consistent with our view that Fed officials are likely to look through the one-time price level adjustment from tariffs, absent a move higher in inflation expectations. Second, more disruptive tariff policy than our baseline. For example, large across-the-board tariffs on Mexico and Canada risks nonlinear negative effects on growth in the short run. Along these lines, former Fed Governor and Trump appointee Randall Quarles recently argued that larger tariffs could cause the Fed to lower rates more than it otherwise would, despite tariffs' tendency to raise prices. Third, we believe Fed officials would need to see higher prices from tariffs drive inflation expectations meaningfully higher, thus risking a more permanent shift higher in inflation before they started to react. This is something we did not see throughout the high inflation period during the pandemic. In other words, we still think the bar for Fed rate hikes is high. Thank you for listening. That was the 5Ds of Trump's second administration, key economic themes. For future insights, please follow us on your favorite podcast platform. Macro Signposts highlights weekly takeaways from the data analysis conducted by our team of economists and other macro experts. For PIMCO's official views on the global economy, please visit PIMCO.com. The discussion and content provided within this podcast is intended for informational purposes only and may not be appropriate for all investors. Reliance upon information provided in a podcast is at the sole responsibility of the listener. The information included herein is not based on any particularized financial situation or need, and it is not intended to be and should not be construed as a forecast, research, investment advice, or a recommendation for any specific PIMCO or other security, strategy, product, or service. Past performance is not a guarantee of future results. All investments contain risk and may lose value. Investors should speak to their financial advisors regarding the investment mix that may be right for them based on their financial situation and investment objective. Podcast may involve discussions with non-PIMCO personnel, and such content contain the current opinions of the speaker, but not necessarily those of PIMCO. Other podcasts may consist of audio recording of an existing PIMCO article, and such material contains the current opinions of the manager. The opinions expressed in all podcasts are subject to change without notice. Information contained herein has been obtained from sources believed to be reliable but not guaranteed. PIMCO, as a general matter, provides services to qualified institutions, financial intermediaries, and institutional investors. This is not an offer to any person in any jurisdiction where unlawful or unauthorized. For additional important information, go to www.pimco.com/gbl/en/general/legal-pages/podcast-disclosures.